here to hear from UP Global, who announced results earlier this week. As ever, we'll take a canter through the presentation, and then there'll be an opportunity for Q&A at the end. So please feel free to submit those questions as we go along. And as a reminder, we did publish some research as well, which you can go and find on the Equity Development website. So without further ado, I will pass over to the team.
Thank you very much, Hannah. And nice to see such a lot of people on this time. For the people that don't know us, my name is Simon Showman. I'm the CEO and founder of Ultimate Products. This is Andrew Gossage, who's Managing Director, and Chris Dent, who's CFO. Quite an ugly bunch there. That's us. I'm just going to give an introduction to Ultimate Products for, again, the people that don't know us. We employ over 300 people. We sell to 300 retailers across the globe, 45 countries now. And Ultimate Products is a leading homewares brand supplier. We have the most fantastic brands. We have the oldest British houseware brand, which is Salter, which is from 1760, and also Beldray from 1862, Progress 1931. So we look at ourselves now as the home of brands. We sell mass market branded products to most of the retailers in the UK and quite a lot of retailers now in Europe. Our mission is to put beautiful, branded, sustainable products in every home, and that's what we do. What sets us apart from the competitors or the A brands? Our products, our branded products, are just sold above the own label pricing. So beautiful branded products above own label, which creates huge volume. We offer an excellent service to the retailers and the consumer. And over the last 3 to 4 years during the COVID period has really set us apart from our competition or from the A brands. And this isn't narrowing, this is actually widening. We're finding our serviceability, our delivery, our products are really outstanding compared to other people in the market. And the retailers and the retail bosses are seeing this, and the feedback, that's the feedback they're giving us. As an investor, we're a mix of growth and income. You know, we've been doing 50% dividends from the day we floated, 6% growth. We've got a very resilient business model. We've got a diverse customer base. We own just under 90% now of all of our brands, which is fantastic. And we've established a really strong international presence, and that is only going to grow. Our ESG, which you can all go onto our website and look under the investor relations part, is industry leading. We are dealing with all the big retailers that need suppliers that tick this box, and we are the number one ticking the box on ESG. It's not just, ESG to us isn't just to save the world, which we do like, but it's also the most fantastic sales tool, and we use it as a sales tool because retailers need suppliers to have this done for their tick box exercise for scope 1, scope 2, and scope 3. Financial highlights. I'm very, very proud of these figures, especially over the last 3 to 4 years. Chris is going to go into a lot more detail, but it's been hard work to achieve these figures, and I think they're very, very strong. Chris will go into more detail. So just on the operational highlights, and in our company, every 6 months, there's always some great operational highlights because we're always moving on as a company. The appointment of our first ever brand director. We've been in the branded business for 20 years. We've made a lot of it up ourselves, but we've done quite a good job. But we've now employed Tracy Carroll as brand director at Ultimate Products. Tracy's background is from Oxo Housewares, which is owned by Helen of Troy, which is a big American company who have many brands. She was there 14 years. She's teaching us a lot. She joined in November. She was extremely impressed by our speed to market of products. Normally, their speed to market was from conception 2 years. Ours is 4 to 6 months on the shelf. So she's been very taken aback, but she's really engaged with our speed to market. What Tracy is teaching us about the brands is it's not just about the quality, the on-time delivery and the packaging, but the branded experience for the consumer once they open the box at home. When they open that box, what journey do we take them on? And this is where we're going to really ramp up our journey on the branded consumer market, where they open the box and they see the QR code, which takes them into instructions, recipes, warranties, and then onto the Salters website, for example. So that's quite an exciting journey for us, and it's a new journey, the engagement with the customer. The Petra brand, which is our first international acquisition of a brand. Last time we spoke, I told you about that we took a nice big order off one of the big European German supermarkets. That promotion went in December and was a success. And we've had a repeat order now for this Christmas coming because of the success. We forecasted Petra to be £1 million brand this year, but it's gone over the £2.5 million mark this financial year. So Petra to us, we see as a Beldray over the next few years, and we're very excited about putting it into more retailers, and also the large expansion of range online throughout the whole of Europe. And we've also seen a very nice uptake in the French market and the Dutch market on the Petra brand. So a lot more to come with Petra. Russell Hobbs, which has been one of our very strong licenses for over 10 years. We only had a 3-year license on Russell Hobbs. So the minute we signed a 3-year license, it then went to 2 years, 11 months and 30 days and just reduced. Now we've got a 4-year rolling contract, so we've got a minimum of 4-year visibility. And Russell Hobbs is a great brand, it's a great door opener, and then allows us to get our other brands into the retailers, the Salters, the Beldrays, and the Clean Easers and the Progress. So we're very pleased about that. It's taken the license really off the table for us and the worry. ESG, as I've just explained, it's fantastic to do. It is very engaging for the team at Ultimate because we've got about 22 people on the committee there. But I love the ESG as well because it also is a fantastic sales tool to the big retailers, because we've done their job and other people haven't. And a lot of retailers, the big retailers now, your Tesco's, your Primark, are reducing suppliers. And one of their metrics is your ESG and your scope 1, scope 2, scope 3. So very, very important for the future of supply. Robotics and AI. A lot of people talk about this, but we do it. We've got 1,000 tasks on our KPI for this financial year. We've just hit over the 400 mark. And again, to me, this is a massive game changer, because it's time, it's process, but it's profitability. And it also allows our teams to concentrate on more important things. There's a lot more to come from us on robotics and AI. Ambiente, which is the biggest houseware show in Europe. We've not done it for 4 years because of COVID. We went really big on it because we hadn't been there for 4 years. We had 2 huge stands and it was a tremendous success. We had 332 appointments in 5 days, and we've split these appointments into A, B, and C retailers. And our big focus on the international side over the next 3 years is to open 10 new big international accounts, ranging from 5 to 10 million each. And then the other 50% of our forecast is to roll out our online business in Europe, which we have been doing the last year. And sales are very strong, but now our focus is to get into stock into Europe. So our test, repeat, and maximize on stock will now flow through. And we're going to get into stock on the SDA, which is the higher volume product. And again, sales we are seeing on our own brands in Germany, Holland, Italy, France. So very, very exciting on the international side for Ultimate Products. We have seen though, we'll show you some graphs. Over the last 3 years, our international business has been steady. It's good turnover, but we've definitely missed sitting in front of the customers. We have definitely missed the exhibitions. And now this is all back on track. We are starting to see the upturn for next financial year. Very exciting things to come on our international supply chain. We want to put this onto the table because it is important to us, and it is something we are watching, which is supply outside of China. We do supply out of India. We have done for 20 years, but we have Pete Rawley, who is one of our senior trading directors, been in the industry for 30 years, knows a lot of Vietnam, India, Poland, and he's heading up our new factories outside of China with a team. And we'll carry on talking about that every 6 months when we all get together. But yeah, a lot of operational highlights, still a lot to do, but it is a very, very exciting company and an exciting future. And I'm going to let Andy now talk to you about the resilience and the track record over the last 6 months.
Thanks, Simon. So on strategy, I wanted to take. I think a lot of you may be familiar with the strategy and with the story, but I wanted to take a slightly different approach for this call. First of all, I want to take a huge step back and say, well, what is it that Ultimate Products does? Because we perhaps, I think reasonably fairly have been accused of, well, how just summarize the business in a few short sentences? It is complex what we do. And for what it's worth, this is the way I see it. For number one, we supply products that have global potential. The products we sell feature on kitchen countertops all over the world. Secondly, we sell them under long-standing British heritage brands, some of which are over 100 years old. And number three, we have an unbeatable operating model, something which we have, I think, demonstrated beyond doubt over the last 3 years. So in summary, products with global potential, number one. Number two, great brands. Number three, unbeatable operating model. And then some of you will be familiar with our 4 strategic pillars, our focus on online, international, supermarkets, and discounters. Okay. If you go back to June 20, in June 20, we were one of the very first listed consumer businesses that reinstated forecasts. Like most listed businesses, we withdrew forecasts in March when COVID hit. We were one of the very first to reinstate forecasts in June 20. Since then, we have only ever met or on occasions exceeded expectations. So we've hit our numbers consistently or beaten them over the last few years. Now, when you look back at that period, other consumer businesses, to my mind, fall into 2 broad categories. Those that saw a COVID bounce and then typically saw a followed by a bust. And secondly, those that suffered during COVID, maybe because their operations were closed and which are now in recovery. We are in a very small cohort which has delivered all the way through that, despite the challenges which you see on the screen, which I know we've gone through in more detail in past presentations. So, we really have shown really quite strong resilience. If you go on to the next page, page 9, these are the numbers. These are, Chris has referenced the last 5 years, and you can see that the growth rates through that period in revenue, profitability, and EPS. But I'd probably pick out the 2019 as the last full non-COVID year, 8.4p. And we've grown that EPS to 14.7p, despite all those headwinds. So the question is, how have we done this? How have we managed to grow profitability and dividends? Because as Simon said, we have a 50% distribution policy over what has been such a difficult and volatile period. If we go on to the next page, slide 10. you'll see here that we've delivered consistent margins. Now I'm going to talk in a few moments about the volatility of our inputs, but one of the things I'm often told is that we are a price taker. We are an intermediary, a distributor, and I suppose we lack pricing authority. Well, for a business that lacks price authority, we haven't half delivered a consistent set of gross margins and indeed improved operating margins over an immensely difficult period for any business and particularly any consumer business. And we've done that, as we said on the bottom of the slide there. Our brands have a following. They bring stickiness to our revenue. That kind of unbeatable operating model and the supply chain competence we've shown over the last few years has been recognised not just by the investor community, but also more importantly in a way by our retailers. New product developments, because this is the way that we refresh our margin. I'm going to talk a bit about inflation in a few minutes. And then finally, productivity gains, a relentless focus on productivity through marginal gains, utilising things like AI or robotics. And now we're on the beginning of the journey since ChatGPT was released to utilise AI. A bit further on that, if we go on to page 11, just to illustrate some of this volatility, Chris has put a couple of graphs there, which has shown the substantial volatility in freight costs mapped against the stability of our gross margins, and also volatility in foreign exchange mapped against that stable gross margin. But Chris could have picked a number of other metrics. He could have picked steel prices, various other commodity prices, factory gate prices, which have fluctuated a lot. And I often end up kind of having sort of almost kind of rabbit hole conversations about direction of travel on this element of our input cost or that element. The reality is that we, as a business and as a management team, can manage that volatility. We can deliver stable gross margins and operating margins. And for me, that's all the evidence that certainly I need. So moving on to page 12, something that I've mentioned brands before. There's been a substantial development over the last few years in our ownership of the brands that we sell. So you can see here, 78% of our revenues come from brands that we own. Obviously helped very much by the Salter acquisition that took place in 2021, but up from less than 50% in FY18. And even the licensing revenue, the 12% that you can see there, which is predominantly all Russell Hobbs, that is on a much different contractual basis than was the case back in FY18. As Simon illustrated, we only ever had a maximum of 3 years visibility on that license. Now we have a minimum of 4 years, so it's a complete sea change in terms of quality here. I'll also mention at this point products. We invoice over 3,000 SKUs a year, 3,000 products a year. That gives us great diversity, and there's always opportunity within that product assortment depending upon where the consumer is. At the moment, the consumer is very much focused on products that save them money, like, for example, the famous air fryer, but also things like airers, heated airers, electric blankets, and even things that help batch cooking, like stock pots and also slow cookers. Next year, it'll be a different set of opportunities, but we have the assortment to deliver that. If we go on to page 13, for me, this is a real big one, and Chris will touch on this when he talks about the various channels and what they've delivered. Back in FY18, we were over 50% of our revenues came from discounters, and that meant that if the discount segments wasn't doing well, we didn't do well. And even within that, there was also quite significant customer concentration. So our top 2 discounters accounted for over 40% of revenue. So again, if those individual retailers weren't doing so well, or for whatever reason they weren't doing so well with us, then again we had an issue. What we have now, we can see, you know, pictorially here, is a much more balanced between the various segments. Online and supermarkets have grown. And what that means is if certain segments are doing less well, others can come to the fore. And that's been crucial over the last few years when we've had this immense volatility with lockdowns and reopenings, shipping crises, and now a cost of living crisis that we're in at the moment. So for the moment, we have a lot of retailers have overstocks, which obviously impacts on what they order from us. But online has returned to growth, partly because of greater availability of stock. Last year, online did less well because the shipping crisis meant less availability of stock to online. Supermarkets did better last year. First half of this year, some of that's reversed. But the great thing about us as a business is we have that diversity of channels and diversity of customers, which means there's always opportunities for us to pursue to counteract what might be certain cyclical issues within an individual segment. Moving over onto page 14, and I'm going to pick this up again a bit later on with the outlook. We opened our I think sometimes things are more apparent in retrospect. You know, when you're in the middle of a crisis, managing it, you're working hard day to day. When Chris put this schedule together for me, it really opened my eyes to something with international. We opened the German showroom in 2018. We saw significant growth in international off the back of that. And then a hiatus over 19, 20 and 21, basically because we couldn't travel to see our customers. And as Simon said, we couldn't do those international trade exhibitions. Ambiente, for example, we've just had the first proper Ambiente for 4 years. So it really opened my eyes. I mean, I was aware of it, but it really opened my eyes to how international has been held back over the last few years. It's one of our 4 main pillars, strategic pillars. I think the handbrake has come off here, and that's hugely exciting. In terms of investments, we continue to drive increase in product life cycles because we online and international enable that. That has a huge impact on our operating efficiency because of the return on investment. Our investment being that product development really makes a difference and has been a big key contributor to that growth in operating margin. We intend to continue to enhance our systems through use of robotics and AI. I've been running companies for 25 years. I've never seen anything like this. I've never seen it. I believe the next 5 years are going to see as more change than we have seen personally in the last 25. And this isn't a technology play. I know it sounds like it is. You know, robotics, we're using Power Automate. It's with the Microsoft suite. It's readily available. AI, ChatGPT, it's available to everyone. This is about combining, it's about the human side that's going to drive this improvement within UP. It's about people spotting those opportunities and driving through that change through the sweating of marginal gains to make a more productive and efficient business. As Simon mentioned, we are looking at diversifying supply chains away from China. That is going to be a slow and gradual process and a challenge that we share with it feels like most of the Western world. But we do take it seriously and we are on it. Number 4, continued investment in our people links in with that technology piece. The graduate development scheme over the last 10 years old, last year, I think, has transformed the business over that time. Together with the robotics and AI, that's going to continue to be a revolution. And I'll just add to this schedule marketing and branding, as Simon said before. We are Tracy's appointments are starting with a rebrand of the Salter brand, which is 260 years old. She'll move on to Beldray in due course, and then across our other brands. So that's a hugely exciting development. Okay, I'll pass on to Chris.
So I think if we look back to January, we got quite used to the supermarkets announcing that they were increasing their revenues by 8, 9, 10%. We haven't done that because we're in quite a different area in terms of general merchandise. So the grocery part of the shopping trolley has seen sort of like 18% increase in inflation, whereas general merchandising has not seen inflation for many years. If you go back to a Woolworths catalogue in the 1980s, you're probably going to see frying pans and kettles selling for pretty similar amounts to what they do now. So that 2% revenue increase that you can see there is coming through our mix and our volume, and not at all through price inflation at all. So revenue up 2% in the period to 87.6 million. Gross margin has also risen a little bit in the period. So part of that has been due to mix. So we've seen a little bit of a change of mix towards online, which has a slightly higher gross margin than our sales to retailers. But in addition to that, we've started to see the benefit in the fall of shipping rates. So over the past 2 years, shipping rates have been quite challenging. So we saw vast increases in the shipping rates as we went through the shipping crisis, and then they started to drop significantly during the autumn. So over 6 weeks, those rates fell significantly. Now, as that works its way through stock, and as the goods are delivered to us, and as we start seeing them coming through to cost of sales, we start to see the benefit of that at the very end of the period. So probably just in January, and we will continue to see that benefit as we work our way through the second half of the year. So when the rates went up, we probably saw a headwind in relation to that of 2 to 3% in terms of gross margin percentage. So overall, gross profit up to 21.6 million. Admin expense line is different from our top line. So there we do see the inflationary environment. So we continue to do the right thing by our people. So wages, which make up 70%, are up by sort of like a cost of living increase of 6%. And also within the period, we've made a renewed investment in going to trade shows. So as both Simon and Andy have said, we have gone back to Ambiente in the current period to really drive our European sales growth over the next period of our growth. So overall, that has left EBITDA steady at 11.2 million for the period. So in terms of digging down a little bit more into the revenue growth, our sales to retailers, so the supermarkets and discounters, are down by 11% in the period. That is mainly due to their overstocks. So what we've seen is that following the shipping crisis and following the COVID boom that many of those retailers had, that they over-ordered on a lot of things, and also it starts to arrive at the wrong times. So we have retailers who have their warehouses full, and also it started spilling out into the ports, that we saw our customers ending up with a large amount of goods sitting there on the docks and not even being able to arrive into stores. So with that, they have ordered less in order to allow those to work their way through. We feel that we're now just starting to reach the end of that overstocking is decreasing. We're probably seeing that happen first in our discount customers and in our UK customers. It's probably true to say that Europe is probably 6 months behind in seeing that overstocking reverse, but we are starting to see the light in relation to that. On the other side, we've seen our online channels grow by 78% in the period. Now, these were held back in the previous year due to the shipping crisis. So we concentrated on making sure the goods got to our retail customers so they're in store, and we actually held back the growth in terms of our online channels. In the current period, we've seen supply issues reverse, and we've really been able to push that online channels. And this is something which we're going to continue to see growth coming from over the next few years. Probably not at the same rate as that 78%, but we're still expecting to see, healthy double-digit growth from our online channels going forward. So moving further down the income statement, we've seen depreciation increase by 90%. So in the previous period, we invested in our head office to make that into a really great working environment for our people. And in addition, we put solar panels on the roof of our main office up in Oldham, which is an important platform as part of our ESG strategy, and we can see that coming through in the depreciation. Finance expense up by 100%. Obviously, everyone's pretty much aware of the way that interest rates have risen very significantly over the past year. So, interest rates have gone from pretty much 0 to 4 or 5%, depending on which jurisdiction we're looking at. The increase in the finance expense has been limited by the fact that we have financial instruments to hedge our interest. So in the first part of the period, we were moving up our interest within our caps that we have. But once we hit the top of our caps, we have then not seen our interest rate increase, as those financial instruments have been successful in limiting the impact of the increase in interest rates. Tax expense is slightly higher than the statutory rate of 19% in the UK, due to the fact that we have branches in Germany and Poland where they have a slightly higher effective rate of interest. So overall, our adjusted profit after tax has slipped slightly by 5%. Against that background of the slight slip in profits, which has caused our adjusted EPS to decrease by 6%, we've increased our dividend by 6% in the period. That is because of our confidence in our numbers for the full year. So if you look at the notes which have been produced by our analysts, including Chris Wickham at Equity Development, you can see that actually for the full year, we're expected to increase revenue by 6 to 7% for the full year, and we expect that to kind of like flow through in relation to our profits. And in some way, this is down to a reweighting of our seasonality. Historically, Ultimate Products has been heavily weighted towards H1. With our online business growing, that has far less seasonality, and we'll see the split between H1 and H2 starting to become less dramatic than it has been in previous years, which is why we have confidence in the full year numbers which are there in terms of the analyst expectations, which is why we have increased that interim dividend by 6% to 2.43p. So just moving on in relation to our cash flow. So in the period, the comparative period last year, we saw quite a large outflow in terms of working capital in the period. That's because we needed to restock the business after a period of supply chain disruption, which had meant that we weren't able to have enough stock in the business. We don't have that similar occurrence in the current year. We are happy with the levels of stock that we have got. Therefore, we haven't seen that same working capital cash outflow. In fact, we're very pleased that we have 114% operating cash conversion in the period. In fact, the only really big outflow of cash out in the period has been in relation to the dividend. So moving on to look at the balance sheet. So as I say, working capital has not shifted particularly. So a 2 million investment in working capital. Net bank debt is now below 20 million, which on on a ratio to EBITDA is now below 1 times. It was at 1.9 last year, so we're really pleased that we have seen that decrease happening. Then probably the only other thing which is interesting on the balance sheet is the derivatives. So our derivatives at the year end were incredibly valuable because we had bought forward at 1.3. Now we're buying forward at 1.2, so we are still buying FX contracts to make sure that we're covering our forward periods. So we have the same hedging strategy, but because now we are through the large amounts of volatility that we saw in terms of the exchange rate, those derivatives, are pretty much at spot rate and therefore don't have as much value on our balance sheet. So I'll move on to Andy to talk us through the outlook statement.
Great, thanks, Chris. So I say, if you look at equity developments notes, 2% growth in the first half, and I think overall for the year, assuming I think from memory 6 to 7%, with a sort of 11 to 12% growth in the second half, which might at first sight look optimistic. We're happy to give an inline guidance on that because, first of all, we have a run rate in our online, which is bigger now and is sort of more dependable. But secondly, we do have visibility of our order book where we have seen an acceleration going into the second half. So yeah, we're happy to give that inline guidance. What I wanted to do was maybe just lift our head a little bit to the horizon, maybe look into 2024. My view as managing director, but also as the third largest shareholder, is what can this business achieve without all these headwinds that we've had over the last few years? If you think about those four channels, international, online, discounts and supermarkets, as they've often taken turns to be down then up because of external factors which were highly unusual. The question I ask myself is what can we achieve as a business with something even remotely approaching a normalized environment? International has been suppressed all the way through that period. That's very clear to us now. So that represents a good upside going forward. In H1, discounts and supermarket were down. They were down because of overstocks. That is a temporary phenomenon which is in the process of reversing, and we can already see strong signs of that. And then online, we just feel, it was down last year because of the shipping crisis. It's come back strongly. We see that as a big growth opportunity really for the foreseeable future, not just in the UK, but also in Europe, where we're still at the early days. Well, some of the things I would just mention as well, we do see as an upside the normalisation of shipping rates, which I think at one point we paid $19,000 at our most expensive container was $19,000 for 40 foot. We now ship at $1,300. As recently as September, it was $8,000 to ship a container. So it's now $1,300. And I do think inflation, inflation as a general merchandise business, it really isn't our friend. We don't get that tailwinds that, say FMCG and food-based businesses have, but we do get inflationary pressures through our salary line, which is our biggest OPEX line. And yeah, despite that, we feel we're on track to deliver growth in revenue and profitability for FY23. So the moderating of inflation provides, I think, a further opportunity as we go through this calendar year. So we're really excited that we could get to a point in the not too distant future where, rather than those four pillars taking turns to be up or down, that we will see them. We will see a growth across a much broader front when it comes to them. Okay, that's all I had on Outlook. Back to Hannah for questions.
Thank you all. And we have a number here. Let's make a start. Would you say that the overstocking situation is fully resolved now?
The answer to that question is no. It's a process. Retailers came back from Christmas. Christmas was better than they expected. That really helped. They have certainly their decision to kind of sort of reduce ordering has had so at the moment we see open to buy easing significantly, and retailers are beginning to order again. But for the moment, they're ordering from stock to fill gaps. So we do see it is improving, and it will continue to improve over the balance of this calendar year. You know, it is you know, for certain. I mean, it's a key variable really. It's definitely an upside going forwards because you know it has been a significant headwind up until now. The big variable is the rate at which the destocking takes place. So we're seeing intel with, you know, if you go back to the autumn, one of our large international customers had 20,000 containers on the quays in various European ports. And the European port, all of the ports, including the UK and Europe, were heavily congested with excess stock. The ports are now completely clear. So that's definite progress. The warehouses are still relatively full, so that's the next step. So you know that is an improving situation, you know, week to week, but we're certainly maybe another 6 months away from being fully normalised.
A nice tailwind.
Yeah.
Okay, we've got one here which probably relates quite nicely back to that slide 10 where you did your lovely consistent gross margin. What's the logic behind the strategy of not increasing prices in a time of 10% inflation? And what benefits did the company get in terms of market share or increased volumes? And will the strategy be reversed in coming years?
Well, I think what I would say, and Simon will, I'm sure, add his view, is general merchandise has historically been fairly close to zero inflation game. It's never really been quite obvious internally, perhaps, and externally, because when inflation is 2%, you don't really notice the difference between 2% and 0% that much. But it's always been something that over the medium long term we've had to manage. You know, we could talk at length about why that is. You know, China joining the WTO and the deflationary effect of China over the long term. What I'd say right now is happening is, you know, the market for general merchandise must be shrinking right now, which again puts into context our 6 to 7% growth, you know, that we're expecting for this year, because we are the other side of the basket from food. The basket isn't any bigger right now, but food is taking, it's apparently 18% inflation on foods. So the market for general merchandise must be shrinking. We don't have any clear data on that yet, but it must be. We're growing, so we must be taking market share. But that's not a great environment to be increasing your prices. So that's the market. To be fair, on the input side, we are seeing some easing because factory gate inflation is pretty close to zero, and maybe even slightly below. And obviously shipping is collapsed as an input cost. So we are seeing cost inflation through our salary line, but we're not seeing it through those inputs to our gross margin.
Okay, thank you. Looking ahead to perhaps other M&A purchase opportunities of brands, are you seeing any out there to buy? And another attendee, I don't know whether they're disgruntled shareholders, asked, why don't you buy ProCook?
Because it's not a brand. We're always looking. Obviously, 9 out of 10 of the acquisitions we've done have been at the right price. So, you know, it's got to be at the right price. Salter was the big one we did, and that's been a fantastic acquisition, and we are gaining more market share. You know, we're moving forward heavily into the European market and France. So something called, you know, a French brand comes up. But we've got everything we need to double turnover. So I think focus on what we've got and let Tracy improve the brands that we've got now, and we can double turnover. But we are always on the look, always.
Okay, well, leading on from that then, if international is the key, then surely your British brands will become less and less important.
No, the British brands we've been selling in Europe for 10 years, and it did worry me, would it work? But Beldray works very well. Russell Hobbs is a great British brand, and we use that as our door opener to the big retailers because they really like it. Salter is working. Progress is really strong and growing in Europe. So we've got the brands. Well, like I said, if the right European brand comes up, we have the firepower.
Okay, can you break down a bit further what's happening in Germany in the short term with the sales decline, even though Petra has successfully launched there?
Yeah, with the retailers that we are supplying them, the supermarkets, over the last 24 months have been very heavily overstocked. And like Andy said, we are starting to see that clear and they're coming out to play for next financial year. And we're having great meetings with them. And Ambiente was a fantastic breeze block to start that back off. Very confident about the German market, very.
In terms of the overstocks, just to give a little bit more colour there, it does look like, and these are wild generalisations on an individual retailer level. There's lots of differences, but on average, it does appear that that Europe is 6 months, is behind the UK in terms of resolving those overstocks. We are perhaps more optimistic on that than we were a month or two ago. It does look like they are making decisive moves to deal with that, which will then release open to buy, which will then lead to us taking orders. But one of the things we're sure of, because of the way retailers reacted to UP and its performance over the last few years, is when that open to buy, when retailers convert stock into cash and therefore open to buy, we are very confident that we are at the front of the queue. With the way we're perceived by blue chip retail, both in UK and Europe, has been transformed by the way we performed over the last 3 or 4 years. Mm. So fundamentally, it's not like we're sitting here saying we've lost shelf space. We haven't. We're gaining shelf space. It's just that there's this temporary situation where they've got too much stock in the warehouse, and they're letting that flow through. Okay, thank you.
Nice question here on your endeavours to build non-Chinese sourcing. What would be optimal in 5 years' time, or perhaps longer, in terms of the balance between where you get everything from?
So I'm not actually going to answer that question, Hannah, and because I think it's going to be very gradual, and I think it's sometimes it's going to be 2 steps forward and 1 step back. This is a huge challenge that the entire West faces. Not all of the solutions are in our hands. So it'll rely upon, for example, supply chains being built in other territories, like say Southeast Asia, or indeed Europe and India. That's not in our gift. What I will say is we are completely on this, and there is precedence, by the way. Our co-founder Barry Franks made his career in clothing. And clothing 20 years ago transitioned from China to other territories, like, for example, Bangladesh and whatever. But it is a relatively slow process. As you find those partners you can work with, and they in turn build their sort of secondary supply chains. So I'm not gonna stick it on the block yet. Maybe in 18 months' time.
You answered the supplementary question of how hard is it going to be. Right, great. What's the shape of demand for energy efficient appliances been like recently, since a lot of anxiety about heating and energy has come out? Are you still seeing disproportionate strength in SDA, small domestic appliances?
Obviously, saving money is critical at the moment for 99% of households. And we've done a really good job on that with the SDA products. And I do think that's going to continue into next year. Obviously, the air fryer is a very successful product, slow cookers, the airers. But again, giving the consumers those products and proving that they save money. Now, with the air fryers, you are hearing stories that people are buying an air fryer and they've not stuck their oven on for 3-4 months. You know, and we have got the full certification that it does save 69% of energy. You know, so you know, it's a big focus of ours because we do want to help the consumer.
Can I just add to sort of a wider perspective to that? We are beautiful products for every home. Should have mentioned that earlier. That's our mission. Beautiful products for every home. So, and it can feel a bit counterintuitive, our approach. So normally when people build brand equity, they charge a premium for that. We go the other way and use that brand equity to drive volume, because we want our products to be affordable to all households in the UK and beyond. And when it comes to our part of the cost of living crisis, we feel that we are a solution to many households on a wider front in terms of reducing their costs.
Chris, one for you. When do your current interest rate cap swaps expire?
So we have a suite of these. So they are designed to map the decrease in our net debt. So we have term loans that we took to take to do the Salter acquisition. So they run out during the course of 2024, and the last one is early in 2025. So at the moment, I feel that we've absolutely got sufficient for seeing our net debt drop to just about zero. Yeah, there we go.
Thank you. Going to try and sort of shoehorn two together here. When winning space in the EU, are you replacing any incumbent products? And I guess, are you seeing any lingering effects from Brexit?
We're always replacing incumbent products, but we're replacing them with new innovative products and better packaging, better pricing. Otherwise, they're not going to give us the shelf space. On the Brexit side, I do feel us as a company reacted to that very quickly on the systems wise, and we're don't see no issue.
We've never really seen much issue selling into Europe because we're British. But I'd hope with recent developments that maybe some of the rancor that there's been around Brexit is easing, and I think that's got to be a positive. I really do. But it's never been that's never been a particular issue. The challenges have always been logistical. And even they've not been huge, because the vast majority of the product we sell in Europe has always gone straight into Europe from China and has not been kind of cross-border from the UK anyway. But yeah, I'm certainly going to welcome us talking about Brexit less and maybe getting along a bit better with our European friends, because we have a lot more in common. What we offer those to go to the first part of that question, what we offer those consumers and retailers is that concept of a beautiful product, the beautifully designed products. Look, we use the word beautiful very deliberately. It's not just stuff that delivers the function. It's got to be aesthetically pleasing. And my sort of rule of thumb is, when you put it on your countertop and your friends come round, do you leave it on the countertop or do you stick it in the cupboard? So it's got to be a product that you can be proud of, and that's quite unusual. It's unusual in the UK, but we feel that's a highly unusual proposition in European mass market retailers, where it's often just purely about price and function. So we believe in bringing something to that market that they've never seen before.
Thanks. Next one's on visibility, particularly with your retail customers. Do you get any a sense of it on a weekly or monthly basis, and any sense of how this is comparing to 2019 and general trends?
Sorry, just say it again, Hannah?
Visibility on the weekly and monthly sales of products going through by your retail customers, and how it compares back to 2019.
Yeah, yes, we do have systems, and certain retailers have systems to give us that visibility on stock. But I don't want to talk about retailers and their orders going up, or the visibility from a retailer. I don't think it's right.
We certainly haven't gone to the extra step of comparing to 2019. I think we have, where we do have visibility, for example, on call-off accounts, retailers vary. Some give you absolute visibility at point of sale, and all the way through to retailers that point blank refuse to give it to you, and then sort of shades in between. Where we do have visibility, I think there's no doubt that the market for general merchandise at the moment, because of the inflation on food, is harder than it has been in the past. And that's why I was so proud of the fact that we've grown revenue and volume in that very, very difficult market.
Questions keep coming. Salary costs are up 6%, admin costs are up 8%. Where is the benefit of robotic process automation?
I think part of that can come down to the change in sales mix. So online has a lot higher cost to serve. So if you're looking at our DC, for instance, in our warehouse, where that is where we have been making a lot of the process changes, we've been able to put a 78% increase in the flow through there in what is the area with the highest cost to serve, without seeing a significant increase in that. And it is also, in terms of our office people, in terms of the tasks that we are taking away from them and the tasks that they're now being freed up to do. So, we are taking away from them, and it's now being done by a robot, some of those very boring admin tasks, which take them 2 to 3 days at a time. And we're freeing up that time to move on to more problem solving and more and better quality development of new products. So what that enables you to do is build a platform and have the people which is scalable for the future. So no, we aren't seeing it directly in this period of time, but it is building that scalable model for the future.
Hannah, I'm going to answer that question a bit more bluntly. If you want to see where robotics and AI is, look at our operating margin. So the 8% has been part of that, by the way, which is we have started to reinvest in international exhibitions. That is a new area of cost we haven't had for the past few years. But when it comes down to it, investors, I suppose, have got to make a decision about trusting management to manage the various inputs and outputs that come through the business. And for me, the ultimate test of our operating efficiency is that operating margin, which you can see on page 10. We've grown from just above 8% to over 12% since FY18.
Absolutely, and the performance for the last 3 years attests to that. Right, great job all. How many products do you expect to launch this year? How many SKUs are in the portfolio? You touched on some of this with your rationalisation with Tracy.
Over the next 12 months, minimum 600 to maximum 800. But what we are seeing is more longevity in the products. So we averagely invoice 3,000 SKUs a year. That's gone up to 3,200 because products are lasting longer with our international business and the online business. But new innovation and product development is at the heart of the company.
You haven't mentioned recession. How much of a headwind do you think a proper economic slowdown will be?
Well,
I mean, you've already said you're taking market share.
Yeah, recession's easy after COVID. Foreign recession, give us a recession, that's fine. We'll handle it like we've handled the last 3 to 4 years.
Take the punches. I'll take that. And I think just a point of order here. Obviously, you've moved results forward. Usually, we're speaking to you in about another month's time. Will there now be a scheduled trading update prior to the year end?
I think the next scheduled one is typically August, isn't it? Just after the year end. I mean, the good news will be we'll be paying the dividend a month early. Yeah, which should be pleasing to some of our retail investors. I know I'm pleased. So yeah, but I think we'll have to think about that. But it would normally be, I think, about the 14th of August, wasn't it? When we have visibility of year-end revenue.
But yeah, I think we acknowledge that there is a longer period now. So we'll have a think about that. Yeah,
so it's a fair point.
Fine, thank you. Is a stronger pound good or bad for the profits?
Well, because we take out FX hedges going forward, overall it ends up being neutral, because what we do is we set our margin based on what the current spot rate is, and then when that sort of like occurs, we've got sort of like a hedge in place for that. Obviously, we then need to negotiate the prices on what has happened. So, sterling going down makes it harder, and sterling going up makes it easier. But in the long term, it doesn't actually end up hitting our profitability because of our hedging strategy.
Yeah, just to add a longer context to that, since I've been in the business, I've been here 18 years now, we've been as low as 103 and as high as 208. And we sort of still managed to manage. So it's a currency is managing currency. Obviously, if I had magic wands and if Chris and I could contrive to have a completely stable dollar sterling rate, that would make life a bit, significantly easier. But it is part of our core competency as a business, not just on the financial side through hedging, but on the commercial side, in terms of managing those effects. Over a very long period of time, we do manage that, pretty well, I think.
Brilliant. Well, I'm conscious of the time, so thank you all for your questions, those watching. Gentlemen, thank you for your detailed responses, and we look forward to an update in another 6 months.
Thanks, Hannah.
Thanks everyone for your time.
Thank you, everybody.
Thank you.